Think this was just a quiet week in global markets? Think again. US small caps just took off. China's recovery is stalling. And July 9th, a global trade deadline that could shake everything. If you only listen to one market briefing this week, make it this one. Weekly market update, 2 AIs, 1 former PM, real insight in 14 minutes. Let's decode what really matters, so you stay ahead.
It was a shorter week here in the US, thanks to Independence Day. But if you thought the global markets were maybe taking a break, well, think again. We actually saw some absolutely fascinating activity across the world. Really sets us up for an intriguing month. Our mission today, for you, is simple. Cut through the noise. Think of this as your direct route to being genuinely well-informed on the past week's action, what you need to watch next week, and maybe most importantly, those underlying risks that really demand your attention as we head deeper into July. And to help us unpack this global puzzle, I'm joined by a top strategist from a global bank, someone with this just incredible knack for synthesizing all this information and connecting the dots for us. So today we're embarking on a systematic deep dive. We'll hit the key regions, the US, Europe, the UK, Japan, and China. Then we'll zero in on the critical events coming up next week that could really move the needle. And finally, we'll distill the top 5 macro themes or risks every investor should probably be keeping a close eye on right now. Let's jump right in. Okay, let's kick things off in the US. The market really sprang to life this week, didn't it? Even with the shorter schedule. We saw equities hitting new all-time highs, sure, but what really caught my eye was the kind of surprising strength in smaller cap stocks. I mean, the S&P 500 climbed a solid 1.72%, NASDAQ up 1.62%, Dow Jones surged 2.30%, all strong. But then you look at the Russell 2000 jumping over 3.5%, and the S&P Midcap 400 up almost 3%. It feels like it's broadening out, maybe.
It does suggest a broadening, yeah. And what's really striking, I think, is the resilience we're still seeing in the jobs market.
Yeah.
June payrolls, they significantly beat expectations, came in rising by 147,000. That number, it's undeniably helped calm some of those lingering recession fears, especially after that surprisingly weak ADP report we got just before it. It points to a pretty deep-seated strength in the labor market that's, it's proving quite persistent.
Okay, but here's where it gets really interesting, I think. We have this, clear two-speed thing happening in the ISM data, right? Manufacturing actually contracted again, 4th month in a row. The PMI was at 49.0, so softness there. But then services, the much bigger part of the economy, completely rebounded, back into expansion at 50.8%. How do you read that divergence? What's it really telling us?
It's almost like you said, 2 different economies running side by side. Manufacturing seems to be grappling with maybe external headwinds, inventory adjustments, perhaps feeling that pinch of global trade uncertainty we keep talking about.
Yeah.
Meanwhile, the services sector, it's largely driven by domestic consumption, which seems pretty resilient, and it's just powering ahead. It definitely presents a unique challenge for policymakers. How do you steer that?
Yeah, exactly.
And then you layer on the political landscape. Trump's reconciliation bill cleared both chambers. That's significant. And there's a new trade deal announced with Vietnam. But all eyes now really turn to July 9th. That's a critical deadline for those expiring tariff pauses with multiple trade partners. It's coming up fast.
Right. So, okay, pulling it together for you, our listener, what are the key implications? Strong jobs, easing rate fears, those are definitely helping U.S. markets. But that persistent services inflation we mentioned, coupled with the looming July 9th trade uncertainty, it feels like the Fed's hands are still kind of tied, doesn't it?
I think that's right. They'll likely remain cautious. Aggressive rate cuts seem, highly unlikely despite the market's recent optimism. Patience is probably still the word.
Okay. Now, from that robust but definitely complex picture in the U.S., let's shift focus across the Atlantic. Europe painted a somewhat mixed picture this week. The STOXX Europe 600 was largely flat. The DAX dipped a bit. Others saw modest gains. But the headline news, the really significant milestone, have to be inflation officially returning to the ECB's 2% target. That's a big moment, isn't it? But almost immediately, ECB President Christine Lagarde seemed to kind of pour cold water on hopes for big rate cuts. What's she seeing that keeps them so cautious, even now?
Yeah, that's the crucial question, isn't it? Why the hesitation? And while that headline inflation number looks good, Lagarde was very quick to warn that inflation risks, particularly within the services sector, they still loom large. Services inflation, it's often stickier. It's closely tied to wage growth, domestic demand, things that are harder to control than, say, volatile energy or food prices. So while the headline target is met, those underlying price pressures, They remain a genuine concern for the ECB.
Okay. And speaking of labor, which ties into services, the Eurozone unemployment rate, it ticked up slightly,
Yes.
6.3%.
Just a tiny bit, yes. But let's be clear, that's still historically very low. It points to a remarkably tight labor market overall, which just feeds back into those services inflation concerns we were just discussing.
Right. Makes sense. Now let's hop over to the UK quickly. We're seeing sort of a nuanced signal in their housing market, it seems. Home prices dipped 0.8% in June, according to Nationwide. That might sound a bit worrying, yet mortgage approvals, which look ahead a bit, they surprisingly beat forecasts. So maybe the market is steadying rather than, falling off a cliff.
Exactly. It suggests a potential stabilization, not necessarily a full-blown downturn.
Yeah.
It's not a clear-cut story of collapse or boom, more like finding a level, perhaps.
Okay, so for you listening, the key takeaway from Europe and the UK seems to be core inflation, services costs, they're still elevated, which means the European Central Bank is likely to stay in that patient wait-and-see mode longer than maybe some investors hoped a few weeks ago. Don't expect rapid cuts.
I think that's spot on. Anticipate a more gradual, very data-dependent approach from the ECB.
All right, let's pivot now to Japan. Equities there actually slipped this week. Kind of a contrast to the U.S., wasn't it? Both the Nikkei 225 and the TOPIX saw declines. And it feels like trade tensions and domestic political concerns are really casting a shadow.
Yeah, that's exactly right. What's truly shaping the narrative in Japan right now is the stalled U.S.-Japan trade negotiations. With that critical July 9th tariff deadline approaching fast, we've heard these, direct threats of 30–35% tariffs on Japanese goods from the U.S. if a deal isn't reached. Japan, meanwhile, is holding firm. They want zero tariffs, especially for their absolutely crucial auto exports. It's a real high-stakes game of chicken, economically speaking.
Wow, okay. High stakes indeed. Despite those pressures, though, wasn't there a little bright spot in sentiment? The Bank of Japan's Tankan survey.
There was, yes. A brief one. The Tankan showed large manufacturers slightly more optimistic in Q2. But, and this is a pretty significant bite, confidence is actually expected to slip again in Q3. So whatever optimism was there, it might be quite short-lived, doesn't seem deeply rooted.
And if we connect this to the bigger picture, that political uncertainty you mentioned, that's a real factor too, right?
Oh, absolutely. It's very tangible. You've got upper house elections scheduled for July 20th. Prime Minister Ishiba's government is facing considerable pressure, largely due to ongoing discontent about the cost of living across the country. That domestic pressure, it can definitely spill over into market sentiment, and it could even impact their negotiating stance on trade. It weakens their hand, essentially.
So for you, the listener, the bottom line on Japan, rising political risks, rising trade risks, they could very well overshadow any pockets of positive domestic sentiment we've seen. It feels like a delicate balance tipping towards caution.
Agreed. Caution seems warranted there for the weeks ahead.
Okay, moving on to China. We saw a modest rise in their mainland markets this week. Shanghai Composite, CSI 300 both saw some gains. However, the Hang Seng in Hong Kong actually slipped back, and there are definitely some worrying signs just beneath the surface of those headline numbers.
Yes, the official manufacturing PMI did rise a touch to 49.7. Now, that's still technically in contraction, below 50, but it was stronger than expected. It offers maybe a little relief on the factory front, especially after that May tariff truce. Suggests perhaps a slight easing of those external pressures.
However, here's the crucial bit, I think. The Caixin Services PMI, that's the private sector survey, often seen as a bit more independent, it actually dropped to 50.6. It's a 9-month low. That signals a pretty clear slowdown in hiring and new orders and services, points directly to underlying demand concerns within China's own economy. That feels significant.
It is significant. It points towards domestic weakness, not just external factors. And this naturally raises the question about stimulus, doesn't it? The weak data certainly fuels calls for more support from Beijing. But so far, the government hasn't really unveiled any significant new measures. It leaves investors kind of guessing, maybe getting a bit frustrated, wondering just how much worse things need to get before they really step in decisively.
Right. So for you, the takeaway on China is that the recovery remains quite uneven. It's really a tale of two sectors right now. Manufacturing showing slight improvement, services looking weak, and hopes for robust stimulus, they now seem pinned on, data getting worse, which is an unusual spot to be in, rather than proactive moves from the government.
It suggests they're perhaps waiting for things to get tougher before making big moves. Reactive rather than proactive for now.
Okay, so that's the regional recap.
Yeah.
Now, looking ahead, what's on the radar for you for the week of July 8th to 13th? What are the key dates that could set the tone?
Absolutely. There are a few key releases to watch. In the United States, mark your calendars for Wednesday, July 9th. That's when we get the FOMC meeting minutes. These minutes from their last meeting will offer, crucial insights into the Federal Reserve's detailed thinking, especially amidst that strong labor market and those ongoing global trade tensions we discussed. It's a deeper dive into their rationale.
Okay, Fed minutes on Wednesday. Got it. What else?
Then over in the United Kingdom, on Friday, July 11th, we'll get the GDP month-over-month data for May. This will be an important read on UK growth trends, especially given those mixed signals we saw in the housing market. It gives us a clearer picture of their economic momentum beyond just inflation figures.
Right, UK GDP on Friday. And anything major out of Asia?
Yes, for China on Saturday, July 12th, we're looking at their trade data for June. This includes the balance of trade, exports year over year, and imports year over year. These are really key reads on China's recovery momentum after the tariff truce, and they also give us a sense of overall global demand. Are things picking up or still sluggish?
Okay, so FOMC minutes, UK GDP, and China trade data. Definitely vital to stay informed on those releases. They can certainly impact market direction and sentiment pretty quickly.
Without a doubt, they often create ripples far beyond their own borders.
So as we start to wrap up this weekly deep dive, for you, our listener, let's distill it down. What are the absolute top 5 macro themes or risks investors really need to be watching closely right now as we move deeper into July? What's keeping strategists like you maybe a little bit awake at night?
Okay, let's break it down. First, and probably the most immediate risk, is reignited global trade volatility. That July 9th tariff deadline we've hammered home is absolutely pivotal. We're looking at a potential reignition of trade friction, particularly around the U.S.-Japan talks, but also other expiring tariff pauses. This isn't just abstract. It could quickly shift market sentiment and disrupt forecasts.
Right. Number 1, trade volatility. What's next?
Second, persistent services inflation pressures. We're still seeing that sticky services inflation, especially in the U.S. and the Eurozone. This is really critical for central bank policy paths. It suggests underlying price pressures, often tied to wages, that could keep the Fed cautious and the ECB in that wait-and-see mode even after hitting headline targets. It's the stubborn kind of inflation.
Okay, sticky services inflation. Number 3.
Third, China's uneven recovery and demand weakness. China's recovery remains a significant concern, particularly that slowdown in its crucial services sector and what that means for global demand overall. And the surprising lack of big proactive stimulus measures from Beijing just adds to the uncertainty. It could act as a persistent drag on global growth, impacting commodity prices, export economies, and so on.
Uneven China recovery. Got it. Number 4.
Number 4 is Japanese political and trade headwinds. Japan faces this sort of twin set of headwinds right now. You've got the upcoming upper house elections putting pressure on Prime Minister Ishiba's government, and that's coupled with the lingering threat of potentially significant U.S. tariffs, especially hitting their auto sector hard. These factors are intertwined and could easily overshadow any domestic economic strengths.
Okay, Japan's twin headwinds. And the 5th key risk.
And finally, number 5 is central bank policy divergence and caution. While some economies like the U.S. on the jobs front show strength, the major central banks think the Fed, the ECB, they're clearly signaling caution and a patient approach. This could easily lead to divergent policy paths across regions. One central bank might hold or even hike while another considers easing. This uncertainty around future rate moves, despite all the varied economic data, creates a really complex environment for investors trying to anticipate monetary policy.
Okay, trade volatility, services inflation, China's demand, Japan's headwinds, and central bank divergence. That's a lot to track. And there you have it, a comprehensive yet hopefully concise deep dive into the global market landscape. We packed a lot in, and our real hope is that you, our listener, now feel truly armed with some concentrated insight.
Absolutely. And ultimately, knowledge is most valuable when it's really understood and you can apply it. In this world just awash with information, critical thinking is just essential, isn't it? As you consider these market movements, just remember there's always another layer to explore, and looking at multiple perspectives, well, it truly enriches your understanding.
Couldn't agree more. And maybe a final thought for you to ponder. As we consider these critical July 9th tariff deadlines and these mixed signals from around the globe, strong U.S. jobs versus a struggling Chinese services sector, what truly stands out to you about the undeniable interconnectedness of these markets? How might one region's struggles or even successes ripple across the world, even when another part seems to be thriving on its own? Something to think about. Thank you for joining us on this deep dive.
Good.
And to our expert, thank you so much for guiding us through these complex waters with such clarity.
My pleasure. Always good to discuss.
We'll be back next week to keep exploring and help you stay informed.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.